Hi everybody, Scott Roberts with Nichols Wealth Partners, here to answer a question that I get a lot in my line of business, which is how do life insurance companies actually make money? It's a pretty good question because most people are thinking about their own particular policy and thinking about the fact that they're only paying in a relatively small amount of premiums compared to the large death benefit that's going to get paid out at some point. And you have to also think about the fact that other types of insurance, like health insurance, car insurance, those policies may have a claim, whereas life insurance, as long as the policy stays in force, there will be a claim at some point. It's just a question of when. So to answer this question, we're going to talk about a couple different things. We're going to talk about some concepts of insurance. We're going to talk about risk mitigation and then some of the specific income sources that life insurance companies have. So as far as concepts of insurance, one of the big ones to think about is just risk pooling. So people, when they're trying to figure out how insurance companies are making money, are thinking about just their own policy. But insurance companies are pooling risk. They have a lot of different policies out there. It's not just one policy, because if you only had one as an insurance company, then it'd be more like gambling. Is this person going to live long or not? The other thing that's important to remember is the law of large numbers, which states that the average of the results obtained from a large number of samples converges to the true value. So for life insurance, what does that mean? As the number of policies increases, then the predicted loss will be closer to the actual loss. So what that means is that a life insurance company can reasonably accurately predict the timing and the amount of the death claims that they're going to have to pay out. That's important because when you combine that with the fact that they also are going to know the amount of money they will receive from premiums and their investment in other income, then they can accurately price their products. So how else do they help themselves with pricing the products? Ensuring the timing and the amount of the death claims is more knowable, which they can do through risk mitigation or underwriting. So they're going to assess everybody's health, lifestyle, finances, and they're going to put them into a category, preferred, standard, or some substandard risk, and then they're going to price them appropriately. By doing that, they can also decline some people completely, and that'll reduce the risk of early claims. It increases the accuracy of the loss predictions, and like I said, ensures accurate pricing as well. The other thing that insurance companies do that most people don't know about is something called reinsurance. So they are transferring a portion of the risk to other larger insurance companies, and it protects them from a large loss. So as an example, if a client of mine were to get a $50 million life insurance policy, well, the insurance company that sold that policy is probably only going to retain about $20 or $10 million of that risk, and the rest of it is going to be taken on by a large reinsurance company. So they're sort of diversifying and spreading out that risk. Let's talk just a little bit about the actual income sources. The first one, obvious, you've got premiums, so you've got dollars coming in that's paid. And the other one is investment income. And if you think about it, a lot of life insurance policies are purchased when people are young, so somebody in their 20s, they don't die until 80s, 90s. Well, you have decades of compounding investment income. And compounding interest is, in fact, according to Albert Einstein, the eighth wonder of the world. It's just a powerful thing. If you think about it, a small amount can turn into a much larger amount. And people are thinking about investment income a lot of times over a period of 5 or 10 years. Here, we're talking about decades and decades. So that's a big source of income for them. They also have some policy lapses. So people buy a policy, stop paying the premiums in the future. Obviously, the insurance company doesn't have to pay that death benefit out, but they get to keep all those premiums that have been paid in. This is especially true for term life insurance. So even though the premiums are lower, those are designed to expire prior to life expectancy. So that 10, 20, or 30 years that they last is usually going to get somebody into their 70s, but then the policy goes away. And so all those premiums collected, that's pure profit to the insurance company. Another thing is surrender charges. So let's say it's a permanent policy that's building up cash value and somebody decides, hey, I'm going to cash this in and walk away. Well, if you do that in the early years of the policy, so anywhere between the first 10 to 20 years, the insurance company is not going to give you back all the insurance or all the cash value inside the policy. There's going to be a surrender charge, which they make money that way. As an example, if there's $100,000 in there and you decide to cash it in, you might only get 80 back if you cash it in the early years. So surrender charges. And then the other thing that life insurance companies do is that a lot of them are not only in the business of selling life insurance. Some of them also do health insurance, property and casualty insurance. They sell annuities to make money. They might even do investment management. So there's other ways that they're making money. So as a quick summary here, concepts of insurance that are important to remember when you're trying to consider how life insurance companies make money. You have risk pooling. They're spreading it out with lots of different policies. That lets them use the law of large numbers to accurately predict their losses or their death claims. They use risk mitigation like underwriting and also reinsurance. And then they have multiple income sources. So they've got premiums, investments, policy lapses, surrender charges, other products and services as well. So thank you for your time. I hope you found this informative. Here's some disclosures for you. And if I can help you with any of your clients' needs with life insurance, feel free to reach out, or if you have any questions at all, happy to help. So thank you very much, and have a great day.